Plain text accounting. It's a cool idea, and when I heard about the software tool Ledger, I had to give it a try. Unfortunately, though, immediately after starting, I ran into a problem in understanding, because there is a major difference between the standard way to do double entry accounting and the plain text or ledger way. And that difference is the use of signed numbers to represent transactions instead of debits and credits. I found no discussion of this, so in this video I hope to clarify and give a proper explanation of the difference. Here are some links you should be aware of. Before learning about plain text accounting, I had zero knowledge of accounting at all. I liked dwmbeancounter.com because it explains debits and credits well, and even though it makes no mention of signed number accounting, this is what I referenced when figuring out how to transpose from debits and credits to signed numbers. Plaintextaccounting.org says using signed numbers instead of debits and credits makes them double entry light. The Ledger documentation says Ledger uses only subtractions and additions, although the underlying intent is the same as standard accounting principles. When learning double entry accounting, you will not see any mention of signed numbers. You will only see debits and credits. If you already know double entry accounting, you will not see any mention of how to transpose between the two notations, as far as I know. So, you have to figure it out, and when you do, nobody else will know what you're talking about when you mention it. Your accountant, as far as I know, will not transpose your ledgers, so you have to speak both languages. Alright, how do you do plain text accounting with signed numbers? The short answer is, the Ledger documentation is right. The two techniques are equivalent if you look at it right. I will demonstrate this using some simple algebra. Let's go over the law. This is the fundamental truth that shall not be broken. Besides the law, everything else is convention. The law says what it means to be balanced. In debit-credit accounting, each account has two numbers, debit and credit. The law is, you take all of your accounts, however many accounts you have, and the sum of all the debits equals the sum of all the credits. This means in any single transaction, change to debits equals change to credits. They may both increase or they may both decrease. A transaction shall not increase one and decrease the other in total. Every single transaction is balanced, which means before and after every transaction, all the accounts are balanced. In signed number accounting, each account has one number. The law is, you take all of the accounts, however many you have, and the sum of all the accounts is 0. This means, in any single transaction, there is always increase in some accounts, and always decrease in other accounts. Again, every single transaction is balanced, which means before and after every transaction, the accounts are balanced. The law in signed number accounting is different from the law in debit-credit accounting. Shown here is the most helpful figure I found in my research on the internet. This is the oracle which, after staring at it and going through the example transactions below it, led me to the understanding I desired. As part of convention, not law, we would like to say that the left side equals the right side, property equals property rights, assets equals liabilities plus equity, assets equals liabilities plus owner's equity plus revenue minus expenses minus draws. Whatever. Just think about it simply, left side equals right side. So, to make this compatible with the law of debits and credits, as the bottom row in the chart explains, accounts on the left increase with debits, and accounts on the right increase with credits. And this makes things very confusing in my opinion. Now, here is the key idea which will lead to all of the understanding. In signed number accounting, the law says the sum of all accounts is 0. See the signed number accounts labeled X and Y. X plus Y equals 0. If your world has two accounts and you use signed numbers, one account will be positive and the other will be negative. Let's take an intuitive transaction. We take a loan from the bank. We get cash, an asset, and we owe the bank money, a liability. By convention, because cash is king, we would like to see cash as a positive number, so we have increased our cash, an asset. In signed number accounting, another account has to go down. So our cash went up, but the liability has to go down. Wait, how is this possible if assets equals liabilities? The answer is, it is not possible. And this is where you see that the law of signed number accounting is different from the law of debits and credits. And now on the right, we arrive at the comforting statement that in signed number double entry, liability is a negative number, and more liability is more negative. This will contradict anything you read about accounting with debits and credits, but now you rest assured. Now I will go over the example transactions from DWM Bean Counter. After that, we can compare assets with liabilities to look at owner's equity, and we can compare revenue with expenses to look at profit. I've shown the table on the bottom right so you can see it when it goes off the top of the screen. And the software I'm using here is Ledger, and I'm using Emacs with Ledger mode. Okay, mow the yard. $50, of course it increases cash. Income must go down, so we see more income means more negative. Ledger knows that if I say positive $50 in cash, the remaining account must be negative, so I can omit the negative $50. Purchase office supplies on credit. Well, that's a liability and an expense, but which one goes up and which one goes down? The only way I can reason about it is that I've already determined that liabilities is negative because of the bank loan example, so if liabilities is negative, expenses must be positive. This also makes sense if I bought the supplies with cash. Cash would go down, and thus the expenses would have to go up. Oh, by the way, I'm calling the office supplies an expense, not an asset. I believe the example intended office supplies to be an asset first, and then gets consumed and becomes an expense. Regardless, the end result is that cash goes down and the expense goes up. Newspaper ad. Cash is king. We spent cash, so it goes down. Expense goes up, as just stated. Purchase 5 mowers on a loan from the bank. Liability goes down, as stated, and the assets go up. Mow a lawn, $75 in accounts receivable. Income is negative, as determined already, so accounts receivable goes up. Owner draws. Cash is king, cash goes down. So owner draws must go up. Here's another confusing thing. The owner now has less equity in the company, but the draws are going up. Look at the chart at the bottom right. By the same idea as shown before, if all the accounts sum up to 0, it shows that more owner equity should be a negative number. So this is good. Paying back the company for the office supplies. Cash goes down, so liability must go up. Remember, liability is a negative number, so by increasing it, we are getting closer to 0 liability. Customer pays the invoice. Cash goes up, accounts receivable goes down. Nice, that zeroes out the accounts receivable. Purchase mulch on account. We have already established that liabilities decrease and expenses increase. So accounts payable decrease and cost of goods sold increase. And finally, the yard work for cash. We have already seen this example. Sorry, I made a mistake. There's a spelling error in liabilities, so when I correct that, they will be combined. Now let's look into this. How do we look at profit? Of course, profit is income minus expense, and we can intuit that this lawn mowing business brought in $205 and spent $185, so it made $20 profit. But if you literally look at income minus expense here, you get negative 205 minus 185, which is not right. The equation profit equals revenue minus expense is in terms of debit and credit accounting, so we can't use it directly. Let's look at the equation. All the accounts must sum up to 0. We see that the signed number account W equals the negative of the debit credit account revenue, and the signed number account T equals the debit credit expense account. So if we substitute, we see profit equals negative W minus T. Wow, it's positive $20. Now let's look at owner's equity, which equals assets minus liabilities. Intuitively, we know that the company owes more than it has, so the owner equity should be negative. By the same process as before, substituting the debit-credit account values for the signed number account values, we get a confusing bunch of negative signs, and we see the owner has negative $480 in the company. If the owner had not withdrawn that $500, the owner would have $20 equity. So this makes sense. Notice I did not substitute the owner's equity for negative Z. I could have, but solving for Z is not solving for owner's equity, it's solving for negative owner's equity. Remember, the equations are expressed in terms of debit-credit accounting, and the burden is entirely on you to transpose. You are the only horn player and everyone else is playing strings. I hope that helps. Let me know what you think, and have a great day.